Jake here. Today I'm going to be talking about Netflix, which is the current leader in the streaming wars. I'm going to start off with a brief history of Netflix, then dive a bit deeper into the business, and finally do a discounted cash flow valuation to see if I think they are currently undervalued or not. So Netflix was founded in 1997 by Reed Hastings and Mark Randolph as a DVD mail-based rental business. Reed Hastings is actually still the co-CEO. They competed with Blockbuster for many years before ultimately taking control of the market. They started online streaming in 2007, and in 2014 they began development of original content. Prior to that, they licensed content from other producers, and it was usually reruns. In 2017, they began development of international productions, and in 2021, they achieved the most Academy nominations of any studio with 36, which they won 7 of. They also came to an agreement with Sony Pictures, which gave them exclusive rights to stream content, and they began launching games as a way to hopefully diversify their revenue going forward. In 2022, they lost subscribers for the first time in the first quarter. So the current share price of Netflix has taken a huge tumble, as shown in the picture, dropping over 72% in about 5 months, from a high of $700 to the current price of $190. This picture was taken from a recent report from Netflix showing that 6 of the top 10 TV shows were from Netflix in 2021 and 2 of the top 10 movies. This is according to Google Year in Search, which is global for 2021. And they're hoping to improve on the movies going forward. They said this is a major spot that they would like to improve in. So I made this table which shows content assets over time and the difference between their licensed content versus produced content. As you can see, Netflix has evolved from just licensing content to producing more of their own content as time passes. They predict this will continue to pay off and will show as higher margins in the long term. So this is a graph I found online, which is showing the number of subscribers Netflix has had since 2013. So the last quarter was the first quarter ever where Netflix lost subscribers. They had a net loss of 200,000 subscribers, although 700,000 were lost due to them pulling out of Russia because of the war in Ukraine. So excluding that, they would be up 500,000. That's still well below, I think they forecasted 2.5 million gain last quarter. Then they are now forecasting losing another 2 million next quarter. Despite all that, though, they're still predicting that they will have a net gain over the year 2022 as a whole. So as the streaming business continues to grow, there are now more competitors than I can even name. But I have listed a few of the top competitors here, such as Disney+, Amazon Prime Video, Apple TV, HBO Max, who just recently merged with Discovery, Paramount+, Peacock, Hulu, goes on and on. So some of these competitors, such as Disney, have very deep pockets and are able to spend a lot of money on content. And a lot of them have huge amounts of content already, such as Disney and HBO Max. So the increase in competition is going to hurt Netflix in a few different ways, in my opinion. For one, Netflix doesn't likely have the pricing power that they once had. Most of their competitors are cheaper than they are. In fact, I think all of them are cheaper than Netflix. So they can't just continue to raise prices without the risk of losing customers to other platforms. They're also losing exclusive streaming rights to a lot of shows. For one example of this is the show Friends. Friends was streamed on Netflix, and then Warner Media did not renew the license, and they now streamed on their own platform, HBO Max, which makes sense. And this is just one example. There are multiple shows that this is happening to for Netflix, which is why they are focusing so much on creating their own content now. So Netflix have said they amortize most content on an accelerated basis, with 90% amortized over the first 4 years. So what that means is they likely amortize possibly 50% the first year, 25% the second year, and then maybe 15% and 10% over the next 2 years. This is pretty aggressive compared to some competitors. I think Disney amortizes new content for streaming by 80% over 4 years in a linear fashion, while some of their older content is amortized over a much longer period. I also read something about Warner Media, or HBO, amortizing over 17 years or so. I'm not 100% sure on that. In this graph, I looked at interest over time for Netflix's top TV show, which was Squid Games, and I compared it to Seinfeld, Friends, and the movie Pirates of the Caribbean, just to get an idea of the interest over time. So as you can see, when Squid Games was first released, its interest spiked pretty high, but then it fell almost equally as fast, and now it's basically zero, while the others have maintained a decent interest over a long period of time. I think this shows a major flaw in Netflix's business. Netflix likes to release a whole season all at once, rather than an episode a week over a prolonged period. Although as a consumer, I'd rather binge watch a whole season all at once and not have to wait week by week. But as a business, I think it means there's less people talking about it 6 months later, which can possibly bring more people to the show or to the platform. So in this picture, it shows the share of total TV time in the US, breaking down some of the top streamers and total streaming. So from May 2021 to February 2022, the share of total streaming increased from 26% to 28.6%, while Netflix share only increased 6% to 6.4%. So although Netflix's share of the market is still increasing, it's not increasing as much as you would think. So some of their goals for continued growth. Netflix estimates memberships are being shared by about 100 million households, including 30 million in Canada and the United States. So they have planned to add a new membership option where for a small fee you are able to share with another household. This has the potential to increase their revenue, but I'm not sure how many people are going to be willing to pay an additional fee. But if they were able to convert, say, all 100 million households at a cost of an extra $3 per month, which is very unlikely, but for this example, that would give them roughly 3.6 billion extra revenue per year. They also continue to spend mass amounts on content, although they are talking about pulling back a little bit to maintain their current margins for the next couple of years after the last quarter. They want to introduce a new subscription model that has commercials. This will be a lower priced model, which I think is a good idea. HBO and Disney already have this, I believe, and they've been successful with it. They also want to take advantage of the growing overall market size. They would like to add games, as we've seen in the past year, and their plan is to create an entire ecosystem around certain series, such as Squid Games, where they also sell merchandise. And they want to continue to expand globally, particularly by making Netflix originals in local geographical areas. And their goal is to be cash flow positive from here on out and put all extra money towards buybacks. So now looking at some numbers. So Netflix did $29.7 billion in revenue in 2021. Their cost of revenue, which includes amortization of content, was $17.3 billion, which gives them an operating margin of 21%. Last year they had a net income of $5.1 billion and 393 million in cash flow from operations. So the major difference between net income and cash flow from operations here is the amount that they spent on new content compared to the amortization of content. And they currently have about $14.5 billion in debt, which is not a large amount considering the size of the company. Their goal is to increase operating margin by 3% per year going forward, although that seems to be delayed after the most recent quarter. They mentioned that they want to maintain their current operating margin between 20 and 22% for the next 2 years. They're still predicting a net add on subscribers for 2022, and analysts are predicting 9% revenue growth this year as well as next year for 2023. Thanks for watching.
All right, this is the Disney portion of the Canadian Investors Podcast episode Streaming Wars. My name's Kuhn, and I will be talking about Disney and more specifically Disney Plus. So first of all, the overall business, I do see the role of content creation at Disney to be pretty unique. What I mean by that? Well, if you think about a company that creates different shows, movies, it obviously leads to direct consumption of that. For example, through cable networks, movie theaters, streaming services. But at Disney, they do have the ability to leverage that intellectual property into additional revenue streams, such as the parks experiences. Now, for people who have been to Disneyland, Disney World, or its cruises, these are themed, right? So these are filled with characters that come from the shows. Kids enjoy them because they see familiar characters whom they have seen on TV and then in real life. And then you have this very lucrative business of selling toys, clothing, branded items. This is a very, it's based on the strong brand image of Disney and the characters that it possesses, right? So content creation kind of feeds into revenues in all three areas. I see that in terms of moat, they're also pretty unique for the parks experiences. You don't just build the Disneyland, for example, you have the one in California, one in Orlando, Paris, Tokyo, Hong Kong, Shanghai. These are not built overnight, and they have staying power, right? So yes, they are quite, they require a lot of money to maintain, but these are very unique assets, are not easily replicated. And then you have the toys and clothing. And I admit these are more of the frivolous spending and not as strong a moat, But at the same time, you have to recognize Disney doesn't invest a whole lot in its production. All it does is license its IP. And then you have the content creation. So Disney Plus was introduced about 2.5 years ago, and to match Netflix offerings of online streaming service. And theoretically, if you have a show, right, you can leverage this asset infinitely, send it to all the every user in the world that have reliable internet connection. But at the same time, obviously, this type of business model attracts a lot of competition. So taking a look at the business segments, we can see that they are quite diversified. The biggest component of Disney's business is, I would say, it's not just linear TV, but also theaters, and their cable business, right? And then you have the products and licensing branch, and then you have the consumer parks and also streaming. So nothing really makes over 50% of the business. That suggests that the Disney is going to have a diversified revenue stream that can get us through the tough times. In terms of geographic segment revenue, North America, mostly North America, right? It's 80% of the overall revenue, which took me by surprise a little. But I think the content side, they're all counted as American revenue as opposed to other countries. The other countries probably just only product sales as well as the parks experiences. So one thing I learned by looking at the financials, which I got from Ticker Terminal, is that one of the questions is the direct-to-consumer business cannibalizing its linear TV business? Because in theory it should, right? But we have not seen that in recent years since the Disney Plus launch. Like, it grew by 130%, right, in the 2 years following its launch. But linear TV has roughly stayed the same, right? It fluctuates between 6.7 to 7.5 million each quarter. Hope that continues, but I think in the long run, the direct-to-consumer business will eat into some of that. Although I do agree, some of the TV station revenue and the movie theater is not going away altogether. So it's just Disney's ability to limit its exposure, and right now, its linear TV segment is the most profitable segment. The consumer products and parks each brought in 1.5 billion operating income, which is very encouraging even during parts where they're locked down. So I do think those revenues would be even higher in 2022. And the direct consumer business lost 600 million. I think it will continue to lose money because the CEO has already talked about introducing new shows, and they have to obviously generate new content in order to increase the subscriber count. But I think in terms of the ability to lose money, right, and stay in the game, Disney is probably stronger than most, because if you think about Netflix, they are entirely reliant on subscription revenue. But Disney does have products, that parks, they have the linear TV to cushion the blow, so to speak. All right, so in terms of the financials, these are just got from the Q1 2022 earnings. We can see in terms of streaming, Disney Plus have 42.9 million users, and domestically, and 41 million internationally. Now the Hotstar thing is, I think it's just discounted service, which users can buy for very cheap. That's more tailored towards areas like India. Then most households cannot afford the full price for Disney Plus, right? And in terms of the pricing, you can see in US and Canada, people pay roughly about $6.68 per month. Internationally, almost the same, excluding Hotstar. The Hotstar one would be, it's very cheap. It's only $1. And you have ESPN Plus, and as well as Hulu, which is kind of like, Hulu licenses content from various platforms. And that's been relatively stable. And if you were to compare Disney with the other offerings than Netflix, Netflix seems to be the premier service at $10 to $20 depending on resolution. Discovery has different models for $5 to $7 for the services, no ads. Disney at $7.99 is a bit higher than Discovery. But I think, this entire segment has room to grow because the average cable TV package in the US is about $64.41, right? So when push comes to shove, if these streaming services are able to provide good content, right, with some, like live programming and sports, I think, if you put all three together, right, they're still less than half of the average cable service. So why Disney rather than the other streaming services? I'm not going to talk about the other streaming services too much because the other folks at Canadian Investors Podcast will talk about them. But I see the uniqueness of Disney being focused on children and families, which I think makes the life of the shows longer, right? Because, Mickey Mouse, Cinderella, these things literally last for decades, right? My daughter was still watching the Cinderella from 1950s, even though the quality isn't as good as a more recent hit like Frozen. The lower production costs for the animated series, for example, I show on the screen, right? Like all of these made for children, all you have to do is like a very simple storylines and not very fancy animation, and the song would do. And and parents do pay for it, right? Like I pay for the yearly subscription. I don't regret it at all. And then some elements of these shows have educational component. Right now, I'm not depending on TV to teach my kids, but they are curated, and I do appreciate that fact. I'm a little bit tentative, just let my kids serve the YouTube Kids section, right? So in terms of the total addressable market, let's just look at North America alone. There are 84 million families in the US and 10 million families in Canada, right? So that's 95 million. Currently, Disney Plus have 42.9 million subscriptions. So I think, right, it's just about half of the total addressable market. I'm not saying that everyone will get Disney Plus, but I think there's room to grow because Netflix subscriber count is 74.6 million. So even if Disney were able to grow to Netflix's amounts, then essentially we could see a doubling of the subscription revenue, which would bring, right, just from the D2C business, 2.3 billion per quarter, right, and triple the Q1 2022 net income. Now, of course, right, to increase the subscriber count, they need to invest in additional shows, but I do see this as being very, very scalable. And of course, it will depend on what other companies do in terms of competitive offerings. So this is something I've been wondering, which model is superior? So for Disney, you have the existing franchises like Marvel, Star Wars, the Disney princesses. You can think of a big budget item like Frozen as being like 150 million, but that generated so much in terms of box office as well as product sales. And I think for Disney, they've been going after these low risk, medium return movies because they know superhero movies, Star Wars movies, they will sell. People will, know what they want, and there's a stable market for it. Instead of taking, risky long shot bets. And the second thing is these are made in the U.S. and it's kind of like this Apple approach where everything is closely, like a meticulously planned, curated, and it may not reach certain markets, but they also understand their target market pretty well, right? So that leads to a long amortization of the current assets. And I believe Disney amortizes their content over 20 years sometimes, and they look at their sales each year to determine whether these assets are still worth it or not. Compared to Netflix, where you have this very boom and bust scenario, right? So Squid Game's international phenomenon cost 21 million to make, which is huge returns, right, for 21 million. And The Crown costs 13 million per episode, which is very, very expensive. Now, both of these are hits, but there are a lot of the content that's on Netflix that are not hits. So I think Netflix has the high risk, high return strategy that made these content that made all over the world. It's not more like the open source model, right? Which leads to, a lot of these are not watched very often. So not very long. So this leads to short amortization of current assets. I believe Netflix amortized their content over 4 years. So they could be sandbagging it and pushing earnings artificially low, but it could also suggest that a lot of these contents are just not being watched that long, right? So, and they lack the other methods of monetization like experiences and merchandise. Perhaps one day they'll get there, but currently they're very dependent on subscriber revenue. So, and then, I think in terms of streaming business, there's a elephant in the room. That is YouTube, right? So the YouTube, it's a very different model. They let the content creators take all the risk of production, right? So they don't care, right? So they just host your stuff, and they take a cut in terms of subscription and ad revenue. So how much would YouTube disrupt the TV business, which I'll put Disney and Netflix in there, right? And which one of the Netflix or Disney is closer to be disrupted by YouTube, right? So I think that's for people to think about. So in the end, why Disney? Again, I'm just pitching Disney, and then we'll talk about whether other holes in my thesis. So it is the most differentiated service with the focus on families and children, right? Among the streaming services, it has a huge library of content and existing franchises. They don't have to invest additional money in it. All they have to do is monetize it better, right? And then add additional shows, but not introduce a whole bunch all at once, in order to keep people subscribed. So they're able to generate new content without huge risk taking. Now, they may not have one like Squid Games, right, anytime soon, but they do have predictable cash flows, and the risk reward is positive. And they have synergies with parks and the merchandising business. And lastly, just to reiterate, there's a diversified revenue streams for Disney. It's not like a conglomerate where the businesses don't relate to one another. I think the content creation side do feed into the content consumption, the parks and experiences, and the merchandise sales. So they are kind of like integrated, but I think in tough times, Disney has a easier time surviving than someone like Netflix or Warner Bros. And Discovery. So that's my pitch. Thanks for listening.
Okay, today I'm going to go over a little bit about the qualitative aspects of what's going on with the Warner Brothers and Discovery. So recently we had Discovery Plus merge with Warner Brothers Media and form a new company, WBD. I got to get that. It's still new to saying it. So what we're seeing here and what I think is going to happen with the company and what the plans of the CEO is to utilize HBO and all of their content library properly. So first off, Discovery has been performing very horribly as a stock, which is good if you're looking to buy it now. We've seen Discovery go down over the past while, and here are some of the reasons of what's been going on behind the scenes. So Warner Brothers and Discovery was announced as a merger, and as a part of that merger, they're going to combine both companies, and AT&T is going to give a lot of the debt associated with the Warner Brothers Media aspects of the IP and all of its different business and stuff like that. So coming out of this merger, some of the risk factors are going to be that this is going to be a little bit higher leverage in terms of companies, and usually a little bit higher than what we want to see in terms of how much debt a company has. So that certainly adds on some risk factors, especially with a rising interest rate environment. Fortunately, Discovery has been free cash flow positive. They've been able to grow their free cash flow, and I think they're going to continue to grow the free cash flow. where the big things of the future are going to be is HBO and Discovery Media. They own a whole lot of content, way more content than Netflix has in terms of hours and stuff like that. They own TLC, Discovery, they own CNN now, they own Game of Thrones, Harry Potter, Batman, DC. Like the amount of content and intellectual property that they have now under this deal sets them up where they can actually grow revenue and free cash flow throughout the future while reducing debt without putting too much money in aggressively. So what you've been seeing is in the streaming wars is all of these different companies are competing to create more and new content to get viewers' eyes. Now, Warner Brothers and Discovery has all of this content from 90 Day Fiance to Game of Thrones, all of the other HBO content. They have like contracts with the Olympics. They have all of these different things that I think were very much underutilized under the AT&T brand. AT&T, in my opinion, is not a very well-run company. They're in the later stage of their life cycle, and I think they acquired Warner Brothers Media to try and drive growth because they couldn't do it organically, and because the company is so bloated already, they just dropped the ball with it. With the amount of revenue and the amount of content that HBO and Warner Media had, the fact that they were still free cash flow negative says a lot about how the management was running the company. We've recently seen the stock price drop a lot more after the merger because Warner Brothers numbers came out at the previous earnings call, and they were not good. Discovery had a pretty nice quarter. They were able to grow their free cash flow. They were able to grow their revenue. They were able to grow their subscribers. They hit on every single level. They had a great quarter, and I'm very confident in Discovery's management and their ability to actually run Warner Brothers Media successfully. With the amount of content that they have, and I think they're going into this with around 100 million subscribers, which, yes, isn't as much as some of the other streaming platforms, but I think that gives it more room to grow. And here's how I think they're going to excel above other streaming platforms is they're a lot cheaper. So don't get me wrong. I don't think that Netflix and Disney Plus are going anywhere. I don't think that Warner Brothers Discovery will outperform them in terms of revenue growth or anything like that. What I'm saying is Warner Brothers and Discovery has the potential to print money. Like the amount of free cash flow I think this business is going to achieve after the merger. In original projections from last year, which I think are going to change, management estimated after the merger that by 2023 or 2024 they should be able to hit around 8 to 9 billion in free cash flow. On the most recent quarter, they mentioned that it might be a little bit lower. So we're going to see how that. We're going to have to see once they start reporting earnings and see how the synergies and how Discovery's management is utilizing HBO. There was so much stuff at HBO. Like if you just listen to the most recent quarter, the CEO of Discovery had nothing but bad things to say about how horribly Warner was run. Like, I think he said on the conference call, like, I think they had like $40 billion and they couldn't get any free cash flow. Yet you have Discovery, a much smaller company, able to run a tighter ship and actually convert that user growth and convert that revenue into free cash flow to drive shareholder value in a much better way. So I think that the content library that they have coming out of this merger is going to give them what they need to really outperform in the future. I think that, we could probably see maybe 10% revenue growth over the coming years. But what's really going to be interesting is the CEO and management team have said that they're going to do a very quick deleveraging. So what they're going to do is they're going to pump a lot of their free cash flow, not only into creating new content, but they're also going to put a lot of that into paying down debt and deleveraging. I think they're going into this with a 4 or 5 times leverage, and they're they've committed to getting that down to about, I think, 2.5 times over the next few years. I think that their commitment to realizing that they have a lot of debt and that they're committed to paying down that debt is a really good sign and something that I would like to see from management. And that's one of the reasons why I've been investing in this company. Discovery before the merger was trading at a really cheap valuation. I think it was like less than 10 times free cash flow to market cap, which was really, really cheap at the time. All of this new content is going to be able to drive shareholder value. And I think that the thing that also differentiates them from some of the other is that they're using the CEO talked on the most recent conference call about 3 different monetization strategies. So you're going to have the premium, which is ad free. And then you're going to have a ad light version where maybe you don't want to spend as much money and you're willing to watch some ads. And you pay a lower amount and you get some ads. And then they're also going to have a free version where there's going to be a lot more ads and it's going to be more like you're just watching TV. I think that this is going to drive user growth. It's going to drive the amount of users seeing stuff on the platform without those users actually paying to see the content. And this will give them an opportunity not only to create revenue and free cash flow through the ad revenue that they receive, but they're also able to market their other shows to those people while they have them on the platform. HBO and HBO Max and all of these other brands that they just acquired have a lot of users that they can also cross-market a lot of Discovery's content to. So in summary, I think that, I really like the strategy that Discovery's management has put into place. And I think that they do have what it takes to execute. So what their plan is they're going to continue to invest in new content while paying down debt and not driving up prices and not just spending to create user growth at all costs. They want to be efficient with their advertising. And, I think this is a very conservative management team who is thinking straight and trying to minimize risk and create shareholder value over the long term. So I think that Discovery is a very interesting company. And I'm going to do a deeper dive once we get the next quarter of combined both different businesses. It'll be a lot easier to come up with it will become a lot easier to come up with better valuations and projections for the future. I'm very bullish on the company, and I think there's massive upside potential due to how horribly HBO Max and Warner Media were run while at AT&T. This creates so much opportunity for synergies between the two companies and to drive growth in both platforms. And I really like the management team. From what I've been listening to on the conference calls and what they've shown is they're not out there to burn money. They're out there to create shareholder value. And I think that they're going to do just that. So that's why I consider, even after the drop on this, it's an easy buy for me, but with a limited size position because the debt and the uncertainty after the merger, we don't know how long it's going to take for them to achieve all of the, I think it's $3 billion in synergies that they've said that they're going to have post-merger. There's always going to be growing pains and there's going to be things that don't go as planned. And some of that might come through in the numbers over the next year. So I think over the next year, I would expect there to be a lot more volatility. I don't know if it's going to go up in the next year or 2 years. I do think that over the next 3 to 5 years, this is going to grow quite a bit through user growth and having different streams of revenue, not just $15 or $20 price point that someone has to pay while they try and buckle down on shared passwords. I think on the most recent conference call, they asked them about, are you going after the password sharing? And they said that they have people on it, but it's not really a big issue for them. And I think that's because they're at the lower price point and they do have ad sharing. For $5 or $4, I'm probably not going to be sharing my password with everyone. But for 10, 15, $20, as some of the other streaming services get more expensive, they want to share passwords to cut down on costs overall. So I think that, just to sum it up, the monetization strategy and having the ads to get people in and suggest other stuff to them just drives revenue because, in today's age, everybody wants to stream. Everybody wants to watch that latest show that everybody's talking about. And not everybody wants to dish out the 20, 10, 15, 20 bucks a month. So I think the ad version of it is a really smart move. And I think it's going to really drive shareholder value in the future. And that's about it.